is the the senior loan officers report. And let's just cut right to it. Let's bring it right up. We have the article here from Zero Hedge. And I think the most important part to me is not kind of like what happened. And basically, if you remember, Powell said that he was going to use tightening credit as a way to basically hike interest. In place of hiking interest rates, tightening credit was going to slow down the economy. That was the strategy. We can't hike interest rates anymore or more banks will fail. So instead, we're going to depend. Well, I mean, they did just do a little hike, but that was already kind of baked in. They're going to ease off of that. They're going to pump the brakes a little bit. But what they are going to depend upon is tightening credit conditions. And that's what Powell is mostly depending upon now to soft land the economy, if that actually ever happens. So I thought the most important part of the loan officer report was their forward-looking guidance for the rest of the year. And that's what I want to pick up here from Zero Hedge. While the demand rebound may be attributed to the most modest retracing in yields across the curve in Q2, which has since faded as rates are once again highest in 40 years, mortgage rates. What is more troubling is that looking at the second half, banks reported that they expect further tightening standards on all loan categories. The most cited reasons for expecting to tighten standards were a less favorable or more uncertain economic outlook, the expected deterioration of collateral values. In other words, these office towers aren't what they used to be valued at, and the expected deterioration in credit quality of commercial real estate and other loans. So not only are the valuations, especially of commercial real estate, going down, but the people who want to borrow the money, they themselves, those companies, because they're facing refis, are also less credit worthy themselves. So you have like a double problem there in commercial real estate. You have a declining collateral values, and the companies that are looking to refi also are less credit worthy. And this is especially acute in commercial real estate. You've heard about this, of course, many times. But apparently, this is all also standard on all sorts of categories. So basically, what the lending industry is saying is that if you're looking to get a XYZ loan, it really doesn't matter what it is, whatever it is, we're going to be tougher on you to get that loan. And especially is concerning, if you go further up in that Zero Hedge article, is relative to commercial and industrial business loans. So if you want to, add a wing to your factory, it's going to be tougher to get that loan. If you want to get a small loan for your growing cookie business, because you bake cookies, they're a small business, going to be tougher to get that loan. Going to be tougher to buy that extra panel van because you finish hardwood floors, and that's going to be tough. That's going to be more expensive and tougher to get. All of those loans, whether you're trying to refinance an office tower or buy a panel van, a Ford Transit, going to be tougher to get. All of those things. So that is very pessimistic for the economy. Now, it is absolutely possible that we could have a kind of like a crash. I think we could use the word crash. A crash in commercial real estate that would not impact residential real. Those things, but they could be disconnected, right? And I think that is something we should prepare for. Distinctly, that commercial real estate just could, because of the whole pandemic and this massive lifestyle change thingy that occurred because of the pandemic. I should actually say didn't occur because of the pandemic. It occurred because of our reaction to the pandemic. I think that would be better phrased. In other words, we are our own worst enemy. So I think we could definitely see a dinger in the commercial real estate without a dinger in residential real estate. The huge variable here, and that's why I'm concerned about the commercial and industrial type of loans. The huge variable here is jobs. If we eventually do see jobs start to crater, then the recession is upon us, right? Right? When your neighbors start to lose their job, it's a recession. I think, we have to keep in mind, there's so many people out there saying, oh, the recession's not coming. The recession's canceled, right? You've heard that. The recession's canceled. The Federal Reserve told us the recession's canceled. They also told us inflation was transitory, right? I think, you have to look at the rule of thumb for interest rate hikes and when they actually impact the economy. When did the Fed started raising interest rate? What was that? June of 2022. So we're about 12 months into that process now, and it takes 12 to 18 months before interest rate hikes actually slow the real economy. And so we're just on the verge of that now. So for everyone who's taking a victory lap and saying that there's going to be no recession can't, well, I think you got to keep in mind that it usually takes 12 to 18 months, and more on the 18-month side, before these interest rate hikes take effect. And keep in mind, they raised rates for a long time, so you could start to see a slowdown in the economy like at the end of the year. And then that slowdown actually accelerates going into 2024. That doesn't necessarily mean a decline in real estate prices, at least residential real estate. Might mean it for commercial real estate. Because of the continuing interest rate differential between what's available in the current marketplace to get a new mortgage, which is 7%, versus what most people have. I think Redfin came out and said 62% of people who have a mortgage have a rate lower than 4%. So even if you see some weakness in jobs, you still have to deal with that unbelievable interest rate differential, which, it doesn't seem to be going away at any time, right? That is not going away at any time soon, and no time soon for that interest rate differential. I mean, really, if you have 3.5% mortgage, why would you sell it and and move to a 7.5% mortgage, which is, we're ultimately, I think rates are going to go higher than, right now they're just about 7. I think ultimately they're going to go higher than 7. But why would you do that? Unless you had to, there's a couple of reasons why. But it seems to be better if you need more space to build an addition and get some type of home equity line of credit or something like, and then to refinance the whole thing. That just doesn't make sense unless you absolutely positively have to move.